Hello and welcome back. I'm William Wesley, full life balance financial coach, and we are moving forward in our series of financial coaching sessions. So, quick summary of what we've done so far. First, we covered budget, right? Talked about fixed costs, talked about variable costs, talked about irregular costs, and how do you set that up. Then we spent some time on credit, even broke down the FICO score. What are the major components? What are the things you can do? Then we moved to debt settlement, and we talked about things like debt consolidation and debt settlement and balance transfer and all of that, all the way down to bankruptcy. Well, today we're going to talk about investing, and I thought I'd start off with the disclaimer. First of all, what I'm about to say cannot be construed as formal investment advice. It's information that you may take and use to help enhance your investment portfolio to make sure you fundamentally understand how this thing goes. Also, if you want to take that and then, hey, reach out to me at william@fulllifebalance.com to set a session. I do personal financial coaching so I can help you shape your platform. But today's session and the next session and the next, we're going to talk about investing. We're going to cover the major components of investing. We're going to talk about dollar cost averaging, asset allocation, diversification, the long-term history of the market. And in the course of doing that, I might mention a name or two or a company or two. That's not a recommendation. That is a mention to illustrate a point. So again, welcome aboard. We're going to get started and we're going to talk about investing. This will be our first in the series of 3. Well, today I've rolled up my sleeves and today we're going to talk about investing. I get a lot of calls and a lot of questions about investing, especially now. Now, these videos are timeless because the strategies we're talking about are timeless. But right now, as I record this video, we are in a pandemic, and it's an economic and physical pandemic, and it's causing a lot of financial stress. So I want to talk to you about that. I have a lot of folks saying, so William, what should I do right now with my 401k? What should I do right now with my IRA? What should I do with my brokerage account? Should I get out of the market? Should I stay in? Should I double down? Here's what we know. Long term, the stock market goes up. So I'm going to start with that fundamental concept. And you may ask, why long term does the stock market go up? There are two major drivers. The first major driver is you and I. We are consumers. We buy stuff, clothes, shoes, cars, and that stuff wears out. And where do we buy this stuff from? Companies. And these companies are traded on the stock exchange. So stay with me for a bit, just around this major concept. We as consumers spend almost 70% of every dollar spent in the economy. And that money goes to companies that are traded on the stock exchanges. And as long as, 1, we buy product, 2, we buy product that wears out, we will buy more product. Secondly, there are more people. Every day there are more people. 200, 300 million new babies are born. They need stuff. So not only we're buying stuff, and as long as 1, the population increases, and 2, the stuff we buy wears out, you can infer that long term, the stock market will go up. Now, I'm not saying it goes up like a rocket ship. I'm saying over time it goes up. So you go back to 1987, there was a big crash. And one day the Dow Jones, which is that industrial average of 30 big company stocks, dropped 22%. Then 2001, when dot-coms were just becoming a thing, stock market crashed in 2001. And then in 2008, the stock market, real estate market, and job market crashed. And now, 2020, March of last year, the stock market crashed as a result of the pandemic. We don't know what the next crash will be caused by, but we do know periodically the market does this, but the long-term trend is up. Now I say that to say this. So when a person says, hey, William, I'm scared about what's going on. I have a 401k and I plan to retire in about 20 years. What should I do with the money? Well, history says long-term, you should stay in the market. In fact, let me give you a quick secret. Don't tell anybody. How do you make money in the stock market? It's 4 words. Buy low and sell high. And when can you buy things low in the stock market? When the stock market drops. March of last year, over that entire month, the stock market dropped over 15%. That means good companies like Amazon and Cisco and all of those guys, their prices went down. Didn't mean they were bad companies. It just means their prices went down. So the key to make money in the stock market is to buy low and sell high. I want to buy when things are low. And if I'm already contributing to my 401k, that is out of my paycheck, $300 every 2 weeks is coming out of my paycheck, that stock market money out of my paycheck is going into mutual funds. And mutual funds are basically collection of stocks. And in those stocks, they were at a lower price. So every month I was making my contribution to my 401k. I was buying stocks, and these stocks were at a lower price. What does that mean? That means my average cost for those stocks or those mutual funds is lower. Therefore, when the market comes back, and I have enough history, you can go back 100 years, long term, the market goes up. We have enough history that says long term, especially if you have 15, 20, 30 years, you will have a lower cost of the mutual funds, therefore a higher profit when you begin to cash out. Now, no one can predict the future. This could be the end of the world, then all bets are off. But history says it's not the end of the world. History says this is one of the things that happens periodically. This is the season of COVID-19. We'll look back at some point and say, do you remember COVID-19? You'll also look back and say, I remember my mutual funds were selling at a lower price. And therefore, as I continued to invest in my 401k, and now with the market coming back, my 401k is more profitable. So here's my philosophy. Stay in the market, especially if you're in a retirement account, which is a long-term thing. Now, I'm going to do a couple of quick definitions. One, a 401k is an employer-sponsored retirement account, right? You're putting money out of your paycheck every month. And there are two types, and every company now offers this. You can either have a traditional 401k and a 401k Roth. So first, we're going to talk about the traditional. And again, this is an investing seminar, so we're going to give you a quick overview about investing. There's one major story in terms of any retirement account in terms of taxes. Either you pay taxes now or you pay taxes later. That's the way it is. Either you pay taxes now or you pay taxes later. So in your traditional 401k, you pay taxes later. Here's how it works. Let's say you make $50,000. You put $5,000 into your 401k. At the end of the year, it's going to show on your W-2 that you made $45,000. Why? Because that $5,000 was subtracted from your income. You got a tax break for the amount of that contribution. So you didn't pay tax on it. And every year it made money, ideally over time, and every year you made more contributions. You didn't pay tax. So when do you pay tax? When you take the money out. After age 59 and a half, you go to take it out, and now it's subject to tax. That's the traditional 401k. You're not paying tax on the money you contribute in the individual year. And for some folks, it makes a lot of sense because they want to reduce their taxable income this year. That's traditional. Now here's Roth. Roth says that same scenario. You make $50,000. You put $5,000 into your 401k. But this time, that $5,000 is taxed. So at the end of the year, when you get your W-2, it's going to say you made 50, not 45 like the other one. You made 50 because you're paying tax right now. Why is that a good thing? Because imagine putting $5,000 every year for the next 20 years. That's $100,000. And imagine the stock market does what it does long term, and that is go up. So now your 100 is, let's say, 190, and now you're 59 and a half and you want to retire. When you go to take that money, and this is important, when you go to take that money, there's zero tax on your profit, and you've already paid the tax on the 100. So long story short, it's tax-free, it being the profit. If you made $1 million in your Roth, it's still tax-free. And we don't know the future tax rate, but we know nothing beats zero. Okay, so we just spent a few moments and we talked about, whether or not you should continue to invest in your long-term retirement account. And in my opinion, especially if you have long-term, yes. Even if the market's down, continue to invest. We also talked about the traditional 401k or 403b or 457 or TSP if you work with the government versus the Roth. And they have two different tax treatments. All right, so that's a wrap. I hope you found something that you and your family can use. And if you did, like this video. And if you like it, also subscribe, right? The more subscriptions, the better. In fact, we're going to do a raffle at some point where you'll be able to get some free gifts or even free time because, as I mentioned, we do coaching. So you can reach me at william@fulllifebalance.com. So like, subscribe, and share with your friends and family. And so we again thank you for your time. And as always, we hope you be well, work smart, have fun, and live better every day.